In Australia, the age pension is a valuable income stream for many. It's reliable, secure, and can be a lifelong safety net. Even if you don't care about the payment, you might still want to qualify for even a minimal amount in order to receive the pensioner concession card, which is worth a few $1,000s, offering substantial savings on essential services and living costs. In my last 10 years working as a financial planner, I helped countless people plan for retirement and navigate the Centrelink system. In today's video, I'm sharing 18 tips and strategies to help you maximize your age pension. In order to understand how these tips and strategies work, you first need to understand how the age pension works, especially the assets and income tests. If you need a refresher on the basics, check out this video over here. It's a great introduction and can help fill in any blanks. Essentially, Centrelink assesses both your assets and income in the assets test and income test. And whichever test gives you a lower amount determines your age pension payment. For both assets and income, there is a lower limit under which you will receive the full pension, and the upper limit above which you will receive no pension. If your assets or income fall in between, you will receive a par pension. I have a free Excel and PDF document with the rates and thresholds available for download. You will find the link in the description box down below. Now, this video is for those of you who receive a par pension or no pension at all. Most people in this category are asset tested, meaning they have too much money in the accessible assets. This is generally the case unless you have an ongoing source of income, such as your employment income, royalties, a defined benefit pension, or an overseas pension. All the tips and strategies in this video work by reducing the amount of accessible assets, and most of them also help lower the deemed income under the income test. Before we jump in, just a quick disclaimer, this video is for educational purposes only, not financial advice. While I aim to explain these tips and strategies as clearly and practically as possible, the discussion remains high level. If you think one of them might suit your situation, please take some time to research further and seek professional advice if needed. Without any further ado, let's dive in. Now, tip 1 to 5 are all about fixing your asset valuations. Basically, don't overstate the value of your assets. Sounds simple? There are actually a lot of nuances here, and you'd be surprised how often people get their numbers wrong. The first tip is one that's most fundamental and something you should do right away if you haven't already. That is, sign up for a Centrelink online account. Make sure you know how to navigate the system, check what assets and income they have on record for you, and update your numbers when needed. Think of it as the basic survival skills of being an age pension recipient, like making a good cup of tea. There is a detailed guide on how to do this exactly on Service Australia's website. I will include the link in the description box down below. The second tip is fixing the value of your personal effects, household contents, and motor vehicles. Make sure you report the current market value, what you realistically get if you sold them quickly. You can estimate the value by checking platforms like Facebook Marketplace, Gumtree, or car sales for similar items. Don't report the original purchase price, replacement value, or sentimental value, as this often result in overstated asset values, leading to lower age pension. Here's a bonus tip. When it comes to personal effects and home contents, Centrelink assigns a value of $10,000 by default unless you say otherwise. If you report a value below $10,000, Centrelink will generally accept your assessment unless there are strong indications to suggest that the value is significantly understated. Okay, update it to the current market value. Excellent. But wait, your job isn't done yet. Many people assume that Centrelink automatically apply a rate of depreciation to these personal assets over time. But no, it doesn't. You need to update those figures yourself. So the third tip is to set a calendar reminder to review and update these figures to account for depreciation. This reassessment of market value should be done at least once a year, but ideally every 6 months. A depreciation rate of 10 to 15% per year for personal effects and household contents is generally acceptable, while motor vehicle depreciation can range from 10 to 25% annually, depending on its age, make, model, condition, and market demand. If something unexpected happens, like a car accident that significantly lowers your car's value, or you declutter your home, make sure to log in and update your figures with Centrelink right away. The fourth tip is about the value of shares, managed funds, superannuation, and other market-linked investments. Centrelink updates the value of these on 20th of March and 20th of September each year using the latest market prices or values from your product provider. If the market is booming and your valuation goes up, you're completely within your rights to wait for Centrelink's 6 monthly updates. If there is a market downturn and your market-linked investments take a hit, you can ask Centrelink to revalue your investments at any time. By doing so, you may be able to get either a payment you couldn't get before or a higher payment rate. Just be mindful that Centrelink revalues all your investment at the same time. So even if one has lost a lot of value, you may find that your total asset value has gone up. In such cases, it may be better to wait for Centrelink's next update. Similarly, for investment properties, there could be significant decreases in value that you may want to notify Centrelink about. These are often property-specific issues that may not be reflected in local market trends or indexed real estate market data by postcode, which Centrelink uses for annual or biannual updates. For example, if termites have been newly discovered causing structural damage, significantly decreasing your property's value, you should notify Centrelink as soon as possible. Now may be a good time to highlight how effective reducing accessible assets can be, as the upcoming strategies might involve some big numbers. For those who are asset tested, every $1,000 reduction in accessible assets increase your age pension by $3 per fortnight, or $78 per year. So if you can reduce, say, $100,000 in accessible assets, that's additional $7,800 in age pension annually, a 7.8% return. Tips 6 and 7 are all about loans. Credit card debt, car loans, personal loans, other consumer debt, and home loans don't reduce your accessible assets. So if you have available financial assets, paying off or reducing these debts could lower your total accessible assets, potentially increasing your age pension. Plus, you will save on interest payments, enjoy improved cash flow, and experience reduced financial stress. A win on multiple fronts. It's not uncommon for people to use home equity or take out a loan against their principal residence to buy an investment property. While this can be a good strategy during the wealth accumulation phase, it might become problematic during retirement when trying to maximize age pension. Simply put, loans secured against the principal home, an exempt asset, don't reduce accessible assets. If you are in this situation, you might want to consider refinancing the loan to secure it against accessible assets such as an investment property. Tip 8 to 10 relate to the principal residence, whether you have one or not. Since the principal residence is an exempt asset and isn't included in the assets or income test, using your accessible assets to increase its value can be a smart and legitimate way to shield money from Centrelink. When comparing the assets limits for homeowners and non-homeowners, non-homeowners only have additional $252,000 in both the lower threshold for a full pension and the cutoff limit. We all know that the average home value in Australia far exceeds this amount. This means homeowners receiving the same pension amount as non-homeowners have significantly more net wealth. Let's look at a simplified example. Imagine a couple non-homeowners with total accessible assets of $1,279,500. Since they are at the cutoff limit, they don't qualify for any age pension. Let's say the breakdown of their accessible assets looks like this. They are entirely self-funded, drawing 6% per annum from their super. After paying $700 per week in rent, they have $39,000 left for other expenses. Now, what if this couple uses $827,500 to buy a principal residence? Their accessible assets drop to $470,000, which falls at the lower threshold for a full pension. They can now receive the full age pension of $44,855.20 combined per year. Drawing the same 6% from the remaining super gives them additional $25,800. While the total income is slightly lower than before, they no longer have rent to pay, leaving them with over $70,000 annually to spend. More disposable income and no more worry about rent increases and landlord issues. Which scenario do you think offers a better quality of life? This is a simplified example. If you are considering this option, remember to factor in the cost of buying, moving, and ongoing expenses like home maintenance and strata fees. I'll cover this in detail in an upcoming video, buy versus rent. Stay tuned if this is something you are considering. If you are already a homeowner, upgrading to a more expensive home can have a similar effect. Maybe you have always dreamed of moving to a nicer suburb, or perhaps you have other goals. This approach follows the same idea of converting accessible assets into exempt assets. However, it's a complex decision with many factors to consider. This video is simply here to highlight the possibilities. A common and popular option for homeowners is renovating and making home improvements. Consider spending money on things like solar panels to reduce future electricity costs, upgrading fencing, adding security features, building garages and sheds, or installing more energy-efficient heating or cooling systems. Not only can this reduce your accessible assets and potentially improve your age pension entitlements, but they can also increase your home's value and save you money in the long run. By now, you probably have realized that spending money is the easiest and simplest way to reduce your accessible assets. How wonderful is that fulfilling a lifelong dream could also increase your age pension by lowering your assets? The key, however, is mindful spending. Focus on enhancing your life, not simply squandering money for the sake of a higher pension. Also, keep this SMILE pattern in mind. It's okay to spend more during your early active years, but you need to stay mindful of aged care needs later in life. While we are on the topic of spending, another effective option is prepay expenses, like insurance premiums, rates, travel, rent, or utilities, all essential costs that you have to cover anyway. Prepaying not only reduces your accessible assets, potentially increasing your age pension sooner, but it can also offer other benefits like locking in costs to avoid price increases, reducing financial stress, and simplifying cash flow management. It may even earn you discounts or tax benefits in some cases. One subcategory of prepaying is prepaying funeral expenses. Death and taxes are the only guaranteed things in life, so it makes sense to plan ahead. It eases the burden on your loved ones and could increase your age pension. There are three main ways to prepay for funeral expenses: funeral bonds, prepaid funerals, burial plots. A funeral bond is an investment that provides benefits upon death and cannot be accessed earlier. In financial year 2025, each person can invest up to $15,500 in funeral bonds to qualify for an asset exemption, meaning a couple could exempt $31,000 from their accessible assets. These limits are reviewed on the 1st of July each year. Prepaid funerals and burial plots have no asset limit and are entirely exempt from the assets and income test, regardless of the amount paid. It's worth mentioning that there are some nuances, such as the differences between jointly owned and individually owned funeral bonds, or managing multiple prepaid funeral arrangements. So if this is something you'd like more details on, let me know in the comments. In the meantime, check out the link in the description box down below for more information or seek professional advice. Now let's talk about gifting, a very common strategy to manage assets, support loved ones, and potentially increase age pension entitlements. Currently, individuals can gift up to $10,000 per financial year with a maximum of $30,000 over 5 financial years without affecting their pension. These limits are the same if you are a single or a couple. In other words, couples don't get double the limit just because there are two of you. These limits are not strict caps that say you cannot give more money to your family. This just means that any amount above this limit is treated as deprivation, meaning Centrelink will count it as if you still own it for 5 years. This applies retrospectively even if you are below age pension age. For example, if your age pension age is 67 and you're currently 65 and you decide to gift $300,000 to your children, $290,000 will be treated as deprived asset until you reach age 70. This is why for significant gifts, consider doing so at least 5 years before reaching age pension age or before you become eligible, if it's possible. This way, the gifted amount won't impact your entitlements. But what if you already missed the boat? You're already under age pension and still want to gift. Here's an example given on Centrelink's website for several gifts within 5 years. How it works might surprise you. Centrelink keeps track of your gifting against both the annual limit and the rolling 5-year limit. In this example, we have various gifted amounts in financial year 19, 20, 21, and 22. Let's call this year 1, 2, 3, 4 for simplicity. In the first year, $8,000 was gifted, which is under the $10,000 annual limit. So all good here. It's also added to the 5-year total, which is below the $30,000 limit. All good. No deprived assets are assessed. In year 2, $13,000 was gifted. This exceeds the $10,000 annual limit by $3,000. So that $3,000 will be treated as a deprived asset for 5 years until 31st of May 2025. The rolling 5-year total is now $18,000, which is still within the $30,000 limit. In year 3, $7,000 was gifted, which is below the $10,000 annual limit. Adding this to the rolling total brings it to $25,000, still under the $30,000 limit. No deprived assets here. Everything checks out. Year 4 gets interesting. $11,000 was gifted, which exceeds the $10,000 annual limit by $1,000. Additionally, this pushed the 5-year rolling total to $35,000, $5,000 over the $30,000 limit. As a result, a total of $6,000 will be assessed as deprived assets. This includes $1,000 over the annual limit and $5,000 over the rolling limit, and it will remain assessed for 5 years from the date the $11,000 was gifted. If this person had gifted only $5,000 in year 4, it would have stayed under both the annual and rolling 5-year limits. In that case, the $3,000 deprived asset from year 2 would have dropped off their balance sheet by 31st of May 2025. So if you are planning to gift regularly, it's important to keep track of your gifts and manage the timing and amounts carefully. Of course, before gifting any amounts, always ensure you have enough retirement funding to comfortably support yourself. Number 15 is a game changer. Did you know that superannuation accumulation accounts held by someone under 67 are not assessed for age pension purposes? For couples, this rule can be incredibly beneficial. If one spouse is over age pension age and the other is under, the younger spouse super accumulation account can be a perfectly legitimate place to hide money from Centrelink and potentially increase the older spouse age pension. Here are some effective strategies to shield money from Centrelink. You can use cash savings to make before or after tax contributions to the younger spouse super accumulation account. Another option is to reorganize the younger spouse super account, such as moving the transition to retirement pension or account-based pension back into an accumulation account. Additionally, withdrawing funds from the older spouse super and contributing them to the younger spouse super accumulation account can also work. I have made a dedicated video on this topic where you find a more detailed explanation and example showing how a couple with $850,000 in accessible assets increased the older spouse pension from $293 per fortnight to the full amount of $862.60 per fortnight. It's one of my most well-received videos, so make sure to check it out. And if you like this video so far, don't forget to like and subscribe. Strategies 16 and 18 are highly individual and can work wonders for some people. However, due to their complex nature, they are best explored with a financial planner. I will keep it brief so you know they exist and can bring them up in your discussions with the advisor. Number 16. Consider a lifetime annuity that complies with capital access schedule. What is that? Basically, you use some of your money to buy this specific type of lifetime annuity. It provides you with guaranteed income for life, regardless of how long you live, while simultaneously improving your age pension entitlement because this type of product receives favorable income and assets test treatment from Centrelink. When it comes to the assets test, only 60% of the purchase price is accessible until age 84 or a minimum of 5 years, after which 30% of the purchase price is accessible for the remainder of life. For the income test, only 60% of the annual payment from the annuity is considered. Lifetime annuity can be quite limited and complex in certain aspects, such as flexibility, access to capitals, and estate planning implications. So please make sure to do your research and seek advice if needed. Strategy number 17 is creating a granny flat interest. This involves transferring assets, money, or both for a right to live in someone's property for life. You can have a granny flat interest in any kind of property. It doesn't just apply to properties often referred to as granny flats. Granny flat interests are usually family arrangements providing company and nearby help for older people. It can help reduce accessible assets, but the rules are complex. You should get financial and legal advice before you create a granny flat interest. Finally, a special disability trust can be a strategic way to improve age pension entitlement while supporting a family member with a severe disability. Eligible family members of the principal beneficiary can access a combined gifting concession of up to $500,000. This gifted amount are exempt from the asset deprivation rules and are not included in the income or assets test for the eligible family members who make the gift. It's a complex arrangement, so please consult a financial advisor or a lawyer before establishing a special disability trust. Which of these 18 tips and strategies are you going to use or explore further? If you have any questions, feel free to leave in the comments. Check out this superannuation and retirement planning playlist to find other useful videos I mentioned. Thanks for watching. I'll see you over there.